Hello from Washington and the spring meetings of the International Monetary Fund and the World Bank, which are wrapping up around me. I'm joined by Chris Giles, the FT's economics editor, and Sam Fleming, who is the US economics editor of the Financial Times. Now, we've been talking about the meetings and really the themes that have evolved this week, and we think we've broken them down into four. The first of them, growth. Chris, walk us through it.
Well, if you talk about growth, the premier economic document of this spring meetings, the World Economic Outlook, that was actually a little bit more upbeat. The figures weren't much changed, but really it was mostly in the tone. They were talking about risks being balanced for the first time since 2011.
Macroeconomic risks.
Macroeconomic risks. And really the tone, when you talk to the chief economist, Olivier Blanchard, it was really sounding a lot more upbeat than normal. But when you go to the financial document, the Global Financial Stability Report, that was really very downbeat. So financial risks are rising, and that's very clear. I mean, in the tone of the whole meetings, that they don't really agree here within the building of the IMF. So the macro people, the economic people think it's okay. The financial people are going, oh, we're very scared about two things. One, about interest rates being so low, creating new risks. And secondly, about interest rates rising and that causing a whole explosion or a super taper tantrum.
And that takes us to theme number two that we've detected here this week, and that is the concerns over what was described to us as a possible super taper tantrum caused by the Federal Reserve moving in and moving on interest rates. Sam?
The broad theme about the Fed is if you could get an exit by the Fed, a raise in interest rates, what kind of consequences would that have for the global financial markets? And one consequence, it's only a potential risk that the IMF is flagging up, is that you could have a sudden shoot up in longer term bond yields a la 2013 when we had the taper tantrum. I mean, this time it would be arguably worse because it would be a genuine tightening of monetary policy via higher policy rates. So that's why they called it a super taper tantrum. That isn't the only financial stability risk associated with policy tightening by the Federal Reserve. We also have a lot of concern being expressed in these meetings about the impact on emerging markets, in particular those that have dollar-denominated debt or large external debts. How would they be affected by dollar appreciation if the Fed were to tighten policy, and how would their exchange rates be affected? There's a potential for depreciations by them, which again is a financial stability concern.
What do you make of that risk, Chris?
Well, it's clearly there. We saw it in 2013. We don't know, but sometimes when you raise interest rates or change policy, very unexpected things can happen, and they can be really big. Sometimes it can be all priced in, and that's why you're just seeing this communication after communication saying it is going to happen at some point soon, and then the Fed will just at some stage have to press the button and hope that people do expect it.
And I think that's the point that you do get out of the IMF and these meetings is if you are going to do it, Fed, please communicate it in advance. Don't surprise anyone.
They also do say that they think the Fed has been communicating.
And exactly. Yeah. To be fair, that is the overriding effort by the Fed right now. They don't want to surprise the markets. They're repeatedly saying it'll be slow once they raise interest rates, and they're clearly not going to suddenly turn the corner one day and say, surprise markets, we're raising it now. Or they're going to telegraph it.
The third point, and clearly this has been a huge theme through the meetings and has come up just about any time someone opens their mouth, and that is Greece. And what happens now? Now, what have you detected?
Well, I mean, on one level, Greece isn't discussed in this meeting at all. In the formal sessions,
not officially, yeah.
Nothing.
Yeah.
But it's everything else outside the formal sessions. It is the talk of the town, and the real thing I think I've picked up is the massive, overwhelming unity of all the negotiators with Greece, that they all agree that Greece has behaved extremely badly over the last 2 or 3 weeks, hasn't taken the negotiations seriously, hasn't even got a team in place to negotiate, to get a piece of paper that can be put to politicians. And so at the moment the negotiations are going extremely badly. So the message here to Greece was, get your act together.
And as one delegate put it to me, it takes something to unite the entire Eurogroup members, all 19 members, barring Greece, in one voice. But that is the
never in the history of the euro.
Never in the have you seen such unanimity? But suddenly you do over Greece because of there's just so much frustration you get from everyone you speak about the Greek attitude to this looming deadline.
One of the things that, Chris, you and I have spent a lot of time talking about this week is the kind of repayment schedule to the IMF. And there's been this, there was a sort of informal initial approach, a kind of testing of the waters by Greece on whether you might be able to reschedule this pretty onerous or pretty tough repayment schedule this year to the IMF, which comes out of the first program 5 years ago here. And clearly the IMF holding a hard line on this.
Oh, very, very, very hard line. And no one wants to be the institution that's defaulted to. So the IMF would love it in some ways, as if and so would Greece like to default if they're going to default to the ECB.
And we should point out that Greece, if it were to default to the IMF, would become the first developed or advanced economy to do so. Usually when countries default, people talk about countries like Zimbabwe, Zaire.
Yeah. And you have to remember the IMF isn't a world government, it's owned by its members, and its members include over 100 developing countries who are much poorer than Greece and would think it was rather rum if Greece wasn't going to pay them back for money that they have put into this organisation.
And of course the Greek program has been controversial from the get-go here in the IMF among some people in the board and from emerging nations.
It was striking, I thought, in Mario Draghi's press conference earlier today that he directly took on this question about potential contagion risks if there is a full-blown crisis in Greece.
Walk us through what he said.
Well, in a sense, he said that the euro area is in a much better position than it was in 2012, 2011 or 2010 because of two things he pulled out: the OMT, outright monetary transactions, which have never been used, let's remind ourselves, and QE, which started only in January. This is not what these were designed for, he said, but they're there and they could be used if necessary. The very fact that he actually acknowledged that possibility shows that they're very worried right now.
And I think one thing that's really interesting, there are some real hardliners out there who will speak privately. They won't say this in public.
Right.
They'll speak privately that they would like Greece to go. It's not the majority of the Eurogroup members, but there are some hardliners out there who actually think the Eurozone would be better off without Greece and are willing to say so now.
Which is interesting, and this is something that we were picking up here in Washington beforehand, real sort of anxiety among the Americans that the Europeans were letting this kind of slide and letting this risk build, and Jack Lew said that.
The Americans have been here before, haven't they? They felt that the euro area is a continuing potential dead weight on their economic recovery. They're finally getting a bit of momentum going in the US. The last thing they want is another full-blown economic crisis in the euro area, and that's what Jack Lew said on Friday.
Now, just quickly, we've got to agree that there was one fourth and final theme that emerged here, and that is China, the Asian Infrastructure Investment Bank. It's landed. It's certainly across the road at the World Bank is what they spent a lot of time talking about over there. What do you think is going to change with the arrival of the AIIB?
Depends for who. So for the World Bank, for the Asian Development Bank, it's going to change a lot because direct competition, different governance structure, very much if the sort of voice and the amount of representation of emerging nations is sort of constrained in these organisations, it won't be in the AIIB. For the IMF, not so much. Its role is rather different. It's about a stability mechanism for countries that get into short-term difficulties. So here, I think, not too much worry. Across the road, huge amounts of worry.
Now, Sam, there's also there's an issue that comes up, which is really the concern that the U.S. somehow is disengaging from the global economy and global economic governance. Now, it doesn't totally feel like that here.
Well, Jack Lew made the exact opposite case on Friday, saying the US is recovering and it's doing very well and it's very engaged. He would say that the concern obviously is to do with quota reform in the IMF, where things are log-jammed in Congress. And so I think while that continues, that will, and obviously the AIIB as well, this question about the US's attitude to that institution deciding not to join.
So, well, we could go on all day about this, but really that's all we've got time for. We've got to go off and write some stories. For the FT in Washington, I'm Shawn Donnan. Thanks very much to Chris Giles and Sam Fleming.